All right, everyone. Welcome back to another special report. We got Monty here, who is the writer for the Peach Pit Substack. You can find all of his analysis on there. So make sure you check that out. The description will be down below. But Monty, what great research do you have for us today, man?
Hey everyone, glad to be back on the Peach Pit deep dive analysis. This week's company is Transocean. For those that aren't too familiar with the energy industry, Transocean focuses on contract drilling for offshore and deep sea wells. And this is an interesting industry. It has been dead since 2014 when the oil busted from those high prices that we remember. And I'm from Houston. Other people from Houston, they might remember it just because Houston happens to be the oil and gas capital of the world. But it has been a dead city having its ups and downs in the industry ever since. And I believe it was back in, I want to say 2019, we went through another down cycle for reasons unknown to me. But I digress. Coming into 2023, the energy industry has obviously gone through some very major updates. Back in 2020, producers had decided independently, but almost collectively, that they're no longer going to drill to take on market share. They're now going to stick to their corner, stick to 5% production growth, and maintain supply to meet demand. And looking at the economics, there seems to be, and this is a long-term projection, there seems to be this large dispersion between the supply required or the demand that is going to be needed over the next 20 years and the current supply curve. And if we're not drilling gushers over this time period, we are going to potentially go through a major energy deficit and or energy crisis. So let's dive in to what I was working on this last week. So Transocean, they manage a fleet of 37 drill ships, primarily for deep sea drilling. And, these are the guys that go 100 or so miles off the coast, drill for oil. This is like miles below the sea in search for oil. There are huge reservoirs, huge basins out here, just flushed with oil and gas. So these are the guys that send out the ships to do this drilling. Transocean, they're a bit of a wild card, I'd say. Their day rates are significantly going higher. Some of their ships, they're now contracting for twice as much as they had in the previous year. They're up to, on average, I believe it's somewhere in like the $450,000 a day for their contract drill ships, which, back about a year ago is around 200,000. And they believe within the next year or two, they should reach that 500,000 point. Whether that happens, that's to be seen, but we have a very real opportunity for that to happen. And similar to the oil and gas industry for the E&Ps, where they're drilling to meet demand, Transocean is running a similar playbook to this, to where they have about 12 stacked rigs. They're in shipyards, they're not commissioned, they're just hanging out, eating up costs. And the benefit of this is that they can kind of control the supply of these drill ships out in the ocean. So they can essentially manipulate their day rates higher by limiting the supply of the rigs. I think that's a pretty cool factor, a very good benefit for a company like this in a position that they've been in, and should see them receive some pretty good returns over the next few years. Just some stats to go into real quick. Wood Mackenzie, they estimate 85% of the $500 billion investment in the oil and gas industry between 22 and 25 is going to have a break even of $50 per barrel. Oil is, and I'll misquote here, it's been what, in the high 70s, mid 80s, high 80s for the last couple months now, or the last couple years. It seems to be bouncing around up here. And given the geopolitical tension going on in the world right now, it may remain in the mid to high 80s for years to come, if not go even higher. Some analysts project closer to 120, some expect it to remain in the high 80s, at least for the duration of the year. However, this does provide some significant cushion above that $50 break even.
Who who
Now, of
who
that,
who gave that $50? Sorry.
Oh, that was Wood Mackenzie.
Why did they stand out?
So Wood Mackenzie, they do a lot of analysis on the industry, and
Okay.
that's pretty much their core focus. They do a lot of analyses, contract or consulting type work, things of that sort. So
Okay.
they're essentially a pretty good expert to look at for aggregate data like this.
Heard.
But anyway, so of that $500,000 or $500 billion, 200 billion is expected to be allocated to deep water projects. So for a company like Transocean, their position, and there's a handful of other competitors in the industry. You know, you have Seadrill, Diamond Offshore, guys like that that are competing. But on a comparison basis for sixth and seventh generation drill ships, Transocean takes the cake. They're the ones with the biggest inventory and the biggest fleet to take advantage of these more complicated wells to drill. Um, so let's see. So looking at some of their financials, you know, they have run into some significant challenges over the last few years. Um, and this has been a revolving problem the whole energy industry has faced since 2014, to where they're extremely leveraged. They have this huge debt wall coming due of about 2.2 billion in 2027, which it's still a few years off, but it's still in the back of mind for an investment. You know, you want to make sure that a company you buy into, they're solvent when, you know, you're looking to take your capital gains. But on a long-term projection, it appears that they're capable of increasing the revenue growth, widening their margins, creating that much needed EBITDA, as well as having the ability to pay down this debt. They have a couple options with this debt. You know, they can refinance and push out the maturities like they traditionally have been, pay it down, or, you know, refinance with equity or something of the sort. You know, whatever suits their needs at the time, and it's going to primarily be based on rates, their equity valuation, amongst other things, like their cash flow generation. So total debt, they're running at about $7.5 billion, which surpasses their market cap of just under $6 billion for an enterprise value of $12.5 billion. So that's for me, that's a major red flag for a value investor, for a growth investor that likes that more high throttle risk. You know, it could be a good catalytic type investment, to where, you know, the debt can be the catalyst. That can be what drives the company's price higher, depending on how they address that matter. So there's some pushes and pulls in that. But as far as, you know, their growth goes, they've been able to grow their top line revenue to $2.6 billion, generating just over $500 million in EBITDA for a 21% margin. So they're generating cash. They're generating some good cash there. On a non-operating expense, you know, it goes into the negatives, but, you know, that's not exactly what we're looking for a firm like this. Um,
When you're saying that the debt could be a catalyst, can you break that down a little bit more for the viewers and listeners?
yeah, of course. So for those that are looking for an investment that uh, is impacted by a catalyst like refinancing or paying down their debt, you know, you look for it. I guess the style would be called event driven investing, to where you're looking for a major event that can benefit the company, whether it's a new technology breakthrough, if you're pharmaceutical, you have a new drug on the market that's been approved, or the incremental process to approval. So things of that sort. So their debt, it can be a pretty major catalyst in which, as they pay it down, you know, that opens more cash to be allocated to bigger projects, or to be distributed to shareholders, like potentially us. I currently don't hold any shares. I may hold shares in the future, but currently, as of today, I do not hold any shares. So if I were a shareholder, I'd be looking for them to pay down that debt and potentially enact a share dividend, or proceed with their current share buyback program.
Okay, that makes sense. And what is the ticker here, by the way?
The ticker is RIG.
Okay, this is a very cheap stock.
Oh yeah. Uh,
Yeah.
I mean, it's cheap in price, kind of
Right.
expensive in valuation. So they're currently trading at 22 times enterprise value to EBITDA. Looking at forward estimates for 2023, that goes down to just under 15 times. And on a comparison basis with their peers, the average is just under 15 times at 14.96. So, they have some cushion to grow to meet the rest of the market for what they do. But, the upside as of today or close of Friday, we're looking at a 1% difference on pricing. So there's not a whole lot of upside on the relative valuation, but more so, if these catalysts do happen, if they do see some good revenue growth from day rates increasing and improving, then you know we can see some valuation expansion.
Okay. Yeah. This whole space is really interesting right now with all of the political pushes out of this. Is this I don't know if you looked at this, but for a lot of these, do you ever look at like how what the institutional ownership is?
I do check into it just to see who owns it. Primarily, I look for insider ownership or if there's a large shareholder that has controlling interest of the company. So let me pull that data up real quick for Transocean to see what their institutional interest in. If I can remember correctly, oh, let me get the actual quote, but I think it was somewhere in the mid 60% ish of institutional ownership. But let me pull that information up first before we quote me on that.
Okay.
Let's see.
I just always wonder if there's been sort of an evaporation from these types of companies in the sector over the big push to have more ESG minded investments. And as some of that likely deteriorates because of the lack of efficacy in the policies, that we see more institutional interest draw back to these companies, and then they start to suddenly trade a lot differently than they are now. And just energy in general, because like we've said, the estimate was $50 per barrel all the way to 2025. Was that right?
Or that
over
was
the over
yeah,
the
that's the break
average.
even. That's for the
Yeah.
break even. So
Yeah.
that's the meat. So for a lot of firms, they so a lot of firms look at it differently. A lot of firms will look at it at break even to meet, the cost to operate. If you're looking at Exxon, they take it a step further and their break even is to cover both cost to operate, cover their debt interest, as well as cover their shareholder valuation or value, such as buybacks and maintain the dividend.
Okay.
Um, but yeah, so I was pretty close. It was 66% for
Six.
institutional ownership. So it's still pretty under owned on an institutional basis. It's a good sweet spot to where as it gains more interest by the institutions, that can be an additional catalyst to drive the stock up. So that's one of Peter Lynch's core fundamental values that he looks for in a company. What are the companies that are under owned by institutions? And if it gets more light in the analyst community, can that launch the price up to a more appealing trading valuation? So because the company's so expensive, I'd shy away from it just on that basis. However, based on the under ownership, there could still be a lot of value to squeeze out of it, not looking at their present valuation.
Yeah.
But no, you were absolutely on the ball with institutional ownership related to the ESG challenges to where a lot of firms, and this has been a huge, not just on the banking sector, but a political front on investing in energy firms to where it's just been shunned by the analyst community in that sense. Portfolio managers were getting rid of it on the ESG basis. You know, it was just something that people were overlooking. And I believe, and I'm probably going to be misquoting this, but I believe Greg Abbott of Texas, he was one of the first people to bring a lawsuit towards this, um, for the sake of, Texas, it's a big energy state. And a lot of the companies within the state, that are domiciled in Texas are energy related. So if, the entire industry is being shunned by the analyst community, then, that there kind of goes the state's value essentially. But it seems like, and it seems like the whole political shift has changed now to where people are realizing ESG is a sales and marketing tactic. They're finally
Yeah.
come to that realization, because if you look at a lot of those funds, and not to divert our conversation on Transocean, but if you look at a lot of the ESG related funds, they just charge exuberant fees. They underperform the market, and there's a whole lot of other issues that go into it. You're allocating money in an inefficient basis. And sure, there are some great firms out there that are making solar PVs, that are doing wind energy, but also it undermines the big energy players like Royal Dutch Shell, like Total, like Exxon, that are actually able to finance these projects with their operating cash flow. So, like my personal philosophy is, would I rather risk my money on a company that hasn't proven operational success, or would I rather invest in a company that has profitability and can sustainably invest in these new ESG type projects?
Yeah. No, I mean, those are all great points. And yeah, I mean, I have lots of thoughts, but I don't want to derail us too bad off of Transoceans. I guess the only thing I'd say is I'd love to have get Doom when we have Doomberg on in the future, kind of question him on the line of thought of how much are some of these institutions betraying their fiduciary responsibility to generate as much profits and pick the best investments for people when they're dumping money into these ESG funds that are full of fees and not, the most practical is that, and how do you prove, I guess this should be, how do you prove incompetence over actual
Yeah.
malice almost. That might be a bit extreme to call it malice, but
I know where you're
over
going though.
over
Like,
delusion. Yeah. Because these obviously aren't the best investments to take, and still people pile into them. Whereas companies like this, I mean, how can you not look at the state of the energy market right now, the way that it's being treated? And you're saying that you think that there's been a shift. I still feel like right now my read on the sentiment is that there's still at least at a minimum probably half of people in the investment world still have not realized that ESG is complete BS. And like BlackRock included, and all of them, the biggest advocates who have the most money, still pushing what is basically nonsense at this point to anyone who's been real well informed and done their research. So and I
no,
don't think
absolutely.
yeah, I don't think that's debatable in any sense. I mean, you could debate it if you want to look stupid, but
You
which
better know
plenty,
your facts and figures.
yeah, plenty of people do. So
No, and on that note, just to kind of sum it up, and Goering and Rosenzweig, they do a really good job on analyzing that market, to where if you look at the energy in, energy out, the amount of energy it takes to produce a unit of energy for fossil fuels, you're looking at 1 to 20, 1 to 30, 1 unit of energy in to produce 20 to 30 out. For nuclear power, which is a topic that we've discussed pretty heavily with our guests, it's 1 to 100. Whereas if you look at, renewables, if you look at wind or solar, it's more something in line with 1 to 5. So the EROEI, it is just atrocious. And for the first time in the history of mankind, we are pushing an agenda that essentially takes us back to the Stone Age on energy efficiency. It's like we're forcefully moving away from efficient energy production to something that, one, is extremely costly to not only the citizens, but also to the world, to the earth, to nature. You have to open up these giant mining pits. And this is something I want to get in with Transocean as well in a second. But, you have to scour the earth for all these rare earth metals, go to countries that may not have the best political agenda for its own citizens, and essentially barter with them and empower the governments even further at the risk of hurting its own citizens. And it's just so backwards ass how we have been going about it for the last few years, just trying to get as much of these resources for electric vehicles, for solar panels, for everything, when they're just so inefficient. And that's another topic that we should discuss as well for Finia, for their hybrid vehicle and hydrogen powered vehicle, but that's for another day. um Getting back to Transocean on that note, for precious metals, or not precious metals, for rare earth metals, they actually have a couple joint ventures as well as equity interests in a few companies that are focused in this space. So it's been a topic for the last couple months. I've seen a couple notes on it in the Wall Street Journal here and there. I don't think there's very much activity in the space yet, just given the potential risk to the environment. It's something that's been discussed but not proven yet, to where they're getting into the business of mining these rare earth metals at the surface or the bottom of the seabed. And let me pull up my notes so I can give you some quotes here. But they are, let me find who they were. Sorry, this isn't a core focus of the analysis.
You're good. I didn't even know
We can,
anyone did this.
oh yeah,
Uh,
no, it's been heavily looked at for the last couple years, just given how flush the seabed is with these rare earth metals, and it kind of bypasses having to go to, West Africa, to,
yeah.
maybe a little bit less stable environments to mine for these. So there's a huge opportunity, but it gets into a couple other challenges of who has rights to the oceanic floor and things of that sort. So the
Yeah.
firms that they're working with, that they have equity interests in, are Global Sea Mineral Resources, Ocean Minerals, who is the parent to Mona Minerals, as well as Nauticus. So Global Sea Mineral Resources, they're in the business of developing the technology for deep sea polymetallic nodule extraction. Nauticus is in the business of developing highly sophisticated, ultra sustainable marine robots and associated software for deep sea exploration. And Ocean Minerals is focused on the extraction of the polymetallic nodes. So they kind of covered all the bases when it comes to, you know, the ownership rights, the exploration, the robotics that will physically go down and gather these resources to bring back up. And then how Transocean works into play is, they have the drill ships that can essentially go down, drill into the earth for the extraction of these minerals. So it's, kind of that full circle business plan there, though
Yeah.
there are the challenges. So in my analysis, I found that the New Zealand Supreme Court, they blocked consent for seabed mining off the coast of South Taranaki. France, Spain, and Germany are calling for a ban or moratorium on seabed mining operations. And a few companies out there that oppose seabed mining, BMW, Volvo, Google, as well as Samsung, they've committed to avoid mineral extraction or avoid purchasing minerals that have been extracted from the seabeds. So there's, some firms, some countries that are essentially putting up preemptive roadblocks for this exploration. Whether they know something that we don't when it comes to the ecology, I don't know. That's not my field of expertise, but it seems like the more we venture into the ocean, whether it's wind farms keeping whales up and at them so they can't sleep and die an early death, that might further affect, let's say, ocean currents, or, sea critters that are at the bottom of the ocean that you don't want to look at. Not even a mother could love their face. you know you don't want to screw up, that part of the environment, because if superstorms are real and getting worse, ocean currents and all that stuff, that could potentially exacerbate it. I'm just speculating here, I'm not a scientist, but that would be a very real scary threat to consider when mining these minerals off the seabed.
Yeah. 100%. I didn't know about the wind farms thing killing whales. That's terrible.
Oh yeah, it's like how the ones on land, they keep goats awake and they essentially die of exhaustion.
They kill
It's
they keep goats awake on land.
yeah, goat farmers,
Uh,
they have challenges with windmills, just the noise, it keeps them awake. It's like that
wow.
buzzing noise. Yeah,
I had
it's
I didn't even know they made a noise. I mean, it makes sense, but I, I that's wild. That's wild.
hmm
When I'm tired, I don't
yeah.
think anything can keep me awake. But um
You're not a goat, man. You need
yeah,
to
yeah,
step it
yeah,
up
yeah,
here.
yeah. Yeah, yeah. I eat like one, but um so when we go so overall, then those are some really interesting parts of Transocean. I just don't have a whole lot to comment on that because I don't uh, a lot of this is so new to me. But it's very interesting. The political issues one. I mean, this seems like a very political stock. So if you do not like political risk, or if you don't like politics in general, you might not like this one. But or the sector in general, honestly. But when we're talking about you think it's a bit too expensive? Are you looking for opportunities here in the future? Or what's your take? Do you have a play associated with this that you're looking at right now?
No, absolutely. So for me as an investor, this is very much a show me stock. I want to see some progress towards
Hmm.
deleveraging before I start getting interested in buying shares. And it might be one of those things where I'm too late to the party to take advantage of these potentially lower share prices. The high valuation is my concern when it comes to that, but the lower share price, it's a $770 stock. Could it go up to 20? I don't know. But as far as the valuation goes, I don't see it happening anytime soon. So, you know, personally, I would put a hold on it. If you own shares, hang on to it. If you don't hold shares, be opportunistic and see if the valuation changes for the better. And then you can start acquiring and building a small position, maybe 0.5% to 1.5%, depending on how much risk you want to take on with this company. And again, things I'm going to be looking for are deleveraging. Are they going to be able to generate enough cash flow to overcome that 2027 speed bump? Or are they going to preemptively pay it down? Are they going to preemptively push it out? Just kind of see where they're going before I make a conscious decision to push that buy button on my Schwab account.
Yeah, interesting. All right. Well, hey, I think that about wraps it up. That's one to keep on the radar there. I will say I've been looking over the technicals here, and I mean, this has been, if you're a long-term holder here, this has been an awful ride.
Oh, absolutely.
Yeah,
They just have been beat up, dragged around the cornfields for
yeah,
years, man. Like, what was it? Looks like 2008 was their big drop off. And I guess we were a little bit young during that period. That was during the global financial crisis, but a lot of people kind of overlooked that was a big oil crash period as well. It had what was it? I think it was priced per barrel at around 120 and dropped down. I don't know where it dropped down to, but it took a pretty big tumble before recovering through 2014 during the shale revolution. So it's been, quite a wild ride on the energy front. But, again, going back to the long term thesis, a lot of analysts see that there's going to be a huge supply demand dispersion for the worse. As a consumer, oil prices are going to be higher, potentially continue going higher. And, if Transocean sticks to their playbook, if offshore rigs continue to be in high demand and low supply, they might see that huge Hail Mary turnaround that they've been needing for the last decade of just launching up day rates, seeing their margins expand, and being able to cover those debt payments and become a more solvent company.
yeah. All right. Well, that's cool. Thanks, Monty, for your take and for your time. Make sure everyone go check out the Peach Pit Substack, and we got a few more of these coming out as well. We're covering a lot. Monty has been pumping these deep dives out like
I've been
crazy.
stepping on the gas.
Yeah.
We're looking at 2, maybe 3 a week, and, you know, picking up the volume, making sure that content's out there. You're getting the appropriate analysis that you need to make a conscious decision as an investor. So I always recommend, do not take my word as advice. Do your homework, do your due diligence, make sure you know what you're buying into before you buy it, and make sure you're aware of the risks involved when being a shareholder.
Absolutely. Awesome. Thanks, Monty, for your time.
Absolutely. We'll see you
Yeah.
next time.
Yep. Good luck on the market, guys.